Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate documents into something you can actually understand. Today we're cracking open New York Mortgage Trust's latest quarterly report. And let me tell you, it's a bit of a fixer-upper. We'll be diving into how they're navigating the crazy world of mortgages, interest rates, and a whole lot of financial jargon. But is everything really as it seems? Let's find out. Before we dive in, if you appreciate us making sense of all this financial stuff, make sure you're subscribed. We also have a Discord community linked in the description below where you can chat with other investors and get your questions answered. Come join the conversation. Alright, first things first, we're looking at their financial snapshot as of the end of March. Think of it like a health checkup, but for a company's money. Let's dive straight into the big numbers. Residential loans, which is basically the money they've lent out to people for their homes, are sitting at about $3.9 billion. That's up a bit from December, but it is important to see how this performs because if people can't pay those off, the company is in trouble. Next up, investment securities available for sale. We're looking at roughly $4.6 billion. That's a jump. And it shows where they're putting their cash. Now, flipping over to the income statement and looking at the part that says weighted average shares outstanding, it's sitting at roughly 90 million shares. Time to discuss what they're actually earning. Their interest income is roughly $129 million, but it's only half the story, and the interest expense is roughly $96 million. This means their expenses are eating up a huge chunk of their income. When you subtract the expenses from the income, the company's net interest income is about $33 million. To me, this doesn't sound great since a huge chunk of their revenue went directly to debt service. We need to see what the company is doing about this. Here we have realized losses are roughly $41 million. Ouch. It means they sold some investments for less than they bought them for. Now we have something positive, unrealized gains. It's roughly $118 million. This is the money they could have if they sold their stuff at the current price. Now let's switch gears. Derivative instruments are giving a loss of roughly $46 million. That's a big swing. So let's understand what that might mean. It could mean that their hedges didn't do so well this time around. Lastly, in the income statement, income tax is about $648,000, which is relatively low. Here is the ultimate number, is company-made money. The diluted earnings per common share is $0.33. It's a profit, but is it sustainable? Now, let's look at the comprehensive income statement with other details. It looks like compressive income loss available to common shareholders is $30 million. Okay, now let's switch gears and look at the cash flow statement. First, the cash equivalents, and restricted cash is sitting at $274 million. Looking at the operating activities, and we see net cash provided by operating activities is roughly $25 million. That's what they made doing core business. They used in investing activities with roughly $794 million used. It means they are aggressively investing, hopefully for gains down the road. And the most interesting part, net cash provided by financing activities is roughly $713 million. This is a good sign showing that NYMT is able to bring in cash as it needs it. Alright, so we talked about what happened in the past. Let's look at how the assets are organized as of the end of this quarter. Digging into their agency assets, fixed rate agency RMBS is sitting at roughly $4.3 billion. This looks like a giant number, and it is, but it's important to remember that these are usually low risk bonds, so we should expect lower returns too. Their loans are sitting at roughly $3.9 billion. Let's find out if they expect some big expenses coming in the future. We can see that they have commitments to fund business purpose loans of roughly $184 million. Alright, that was a lot, so let's take a step back and summarize what we've learned. At first, their adjusted net interest income. This is the profit they make from lending and subtracting interest and including other fees as well. Alright, now let's give a final verdict. I'm no credit analyst, but from what it seems, I would be careful on these numbers. For one, the core business is still unstable from a pure value point of view. Their interest expenses are still too high. It is a good sign that they are able to raise money. It gives a lifeline for the company, and it's good to see the company focusing on increasing investments and their asset amounts. So that's my take on NYMT's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.